Hello and welcome to the Mutual Fund Show. My name is Niraj Shah. It's the first show of the new year, of the new decade, to what have you. And it's important to keep an eye out on all of the key aspects that somehow seem to be uh, not only mutual fund investors, but are on top of mind of mutual fund investors. So we asked a few of you on our platforms about what is it that you would want to hear in the new year or the last couple of months. Some tweets have come to me personally on a basis of all of that. We've chosen 4 or 5 key questions that we thought our experts would answer today. So let's get our experts on the show. They need no introduction. Amit Bivalkar and Vishal Dhawan joined us a few times on the show. And gentlemen, both of you, pleasure to have. Thanks so much for joining in today, and happy 2021 to both of you.
Thank you so much. Pleasure being here as well.
Yeah, thank you so much. So let's cut the chase. Let's cut to the chase straight away. There are 5 key things that somehow we learned that people want some answers to, and we thought it's best to ask you. We can, of course, time permitting, include a couple of other things as well. But first up, what's been in flavor in the last couple of months, aside of course equities, is the fact that PSUs have come back with a bang. Now, it's very uncanny that when we were looking at the performances of the thematic PSU funds, they were about 20-22% on a 3-month basis, which is far better than any 1-year record, 6-month record, 3-year record, 5-year record as well. I dare say even 10-year record. So I think there's been a bit of a revival in fortunes of sorts of PSUs, seemingly. Should investors invest in these funds or leave them alone? Either of you can start.
Yeah, I can take that first, Vishal.
Sure, please go ahead.
Yeah. So, Neeraj, Happy New Year to all your viewers as well. And I think most of them have turned advisors because they have been lucky last year making good amount of money starting May. And if you look at PSUs, actually, they were deep value, then became value, and now they are like growth or momentum. So if you look at PSUs, they have some, what you can say, advantages. They are into the cyclical core sectors, so which benefit from the pickup in the economic activity. Over the last 6-7 months, almost everything in the market went up. What were lagging were the PSUs, and I think it was their chance to get liquidity, and therefore they had a good run for the last 3 months. Also, a lot of PSUs have a first mover advantage because it's because of the government's decision that the government will actually allow some of the PSUs to start that business early. And they have a unique proposition either because of access to resources or probably a first mover advantage. The next one is they benefit from the government policies also at times. For example, the oil marketing companies, they have been a big beneficiary of what the government is trying to do. One good observation over the last 6 months is that the return on equity on these PSUs have gone up simply because you are giving away additional capital by way of buyback or dividends. And disinvestment, I think this is a word which we have been hearing for the last decade. I think this government have actually started that process in a big bang way. BPCL will be on focus, and therefore this disinvestment actually unlocks a lot of value in PSU. Therefore, you might have seen some run up there. Needless to say, their valuations are favorable compared to the broader market. And I think therefore PSUs you have seen over the last 2-3 months have performed well. If you have a 3-5 year view, and if you believe that I should be a shareholder along with the government, then definitely you should buy into PSU. But it should be a satellite portfolio and not a core portfolio, according to me, Neeraj.
Okay. Well, Vishal, what's your sense?
So actually, we've been suggesting to investors to actually avoid this segment in spite of its strong performance in the recent past. And of course, everything that Amit mentioned is absolutely true. Value, deep value, government ownership, disinvestment, etc. I think it's just there are 2 drivers of why we are a little uncomfortable with buying into a thematic story like PSUs. One is that the needs for how the government looks at being the largest shareholder of PSUs in terms of how capital is to be deployed and to be used can be very different from what the minority shareholders might require. So, for example, you might find that a lot of the government needs are that a lot of dividends get paid out because the government needs money to spend on other areas. And what you might find in reverse is that a lot of the the requirements of individuals might be that they are investing in equity for growth and for capital appreciation. And clearly, with the way tax structures have changed in the last 12 months, where dividends have now become taxable in the hands of individual investors, we think that PSUs are relatively less attractive, especially if they are high dividend paying opportunities. The second thing that has held us back from going there is that clearly a lot of the diversified equity portfolio managers as well, or mutual funds, will have PSUs as a part of their holdings, especially in areas where PSUs are dominant players. And therefore, there is already an exposure getting built through PSUs indirectly in portfolios, and therefore we don't see the need for adding a thematic specific exposure to PSUs in portfolios.
Interesting point. Can I ask you that? I mean, are you comfortable with other thematics, or are PSUs the only ones, Vishal, for example, that you are not recommending, or you're avoiding thematics at large?
So we do use thematics, very, very frugally in client portfolios. And what we do find is there could be opportunities that sometimes get created around areas like banking and financial services because of the growth opportunities that come there. There could be opportunities that get created sometimes in defensive thematic opportunities that also come up. But in general, we are fairly frugal with making investment decisions in thematic strategies unless we find something is completely out of whack.
Okay. Well, fair call. So viewers, I hope you get your answer. I mean, the recency bias might make you believe that PSU thematic funds might be great to do it. I think Vishal, of course, they're just completely avoiding it. And Amit is saying that even if you want to do it, maybe it's a satellite portfolio, not a part of the core portfolio. So simply put, a large allocation might not be the best idea. Okay. The next question, and I think a lot of people, because they also keep on looking at what's happening in the Western world, etc., and start thinking about how index funds might be better suited for in certain cases. And I think there's a case in point being made by individual experts who track Indian markets as well, Amit, that for a lot of large cap funds, they've barely managed to beat the index, a lot of times just about par. And therefore, why should I pay those high costs to actively manage large cap funds? Let me just stick to index funds. Maybe the argument is not wrong as well. What's your sense about that argument? And therefore, what quantum of the portfolio allocation, purely the mutual fund portfolio allocation, should be done to index investing?
I think the underperformance in the large cap funds, what you were referring to in the last year, has come because of one stock, which is Reliance. SEBI does not allow any mutual fund to go beyond 10% for a single stock exposure, while the index itself had a 14% exposure. And you would have seen the stock moving from 860 levels to 2400. If you have such kind of a move in one single stock, which is the market leader and which is 14% of the index, then definitely your large cap funds will actually underperform. Needless to say, index funds definitely are cheaper in cost compared to large cap, but not necessarily at all points of time you will find the index actually beating the large cap funds. The advisor alpha as well as the fund manager's alpha definitely work well when it comes to managing open-ended, actively managed funds. Second thing is we should not get tied down only to the indices, which is Nifty or Next Nifty or Sensex. I think there are huge opportunities in an IT index, a pharma index, a consumption index. And if you want to play the economy, I think, Neeraj, you also have something called the private bank ETF. So I think index funds or ETFs, definitely a good choice. You need to really look at that whether my fund manager is not able to add alpha, then I should go and buy index funds. Otherwise, if you stick around with open-ended actively managed funds over a 3-5 year period of time, you will always see an alpha created by the fund manager for you. How much will that be? History says it's about 2 to 3% on a year-on-year basis. And therefore, this argument of cheap versus costly on an index versus open-ended is put to rest when you have an alpha of 2-3% as CAGR over the 3-5 year period.
You saying, Amit, that you've seen that happening in large cap funds in the last 5 years compared to index?
Yes.
Or selectively,
If you do a 5-year rolling return instead of a point-to-point or a calendar return, you will find that data.
Vishal, what are your thoughts here? And again, it could be different for different people.
Yeah, so our thought is that actually, indexing should not be considered as just a Western trend coming into India. Actually, there's now enough data to show us, and there have been multiple SPIVA reports over many years now that we've been tracking, where clearly after you eliminate the survivorship bias that exists, which means that effectively the funds that don't do well get merged or closed down, there's a very strong case for index investing to happen in India at this point in time. And it's even stronger in the large caps in terms of an overall approach. So it's not just the cost around it, but it's also just the performance aspects that are very clearly in there. So actually, we've been allocating about 20% of portfolios already to indexes. And what I just want to add to here is that when you're looking at an index strategy, I think it's also a good idea to diversify portfolios internationally. And there are now index products available for an investor to buy into, which invest globally as well. So I would say that both domestically and internationally, bringing index into portfolios will not only help lower cost, but probably also end up becoming core parts of portfolios going forward. So we only see this 20% increasing as time passes, rather than staying static or coming off.
Niraj, one point what I wanted to add here is that if you look at the BSE IPO index, that has the standard deviation which is equal to the Nifty, but has outperformed the Nifty. So I will see some mutual fund coming out with a BSE IPO index ETF, and people might actually invest there as well.
Yeah, well, I'm hoping that if that comes about, we'll be able to give the right advice to the people at that point of time. I'm sure there'll be enough things written about it as well. But yeah, Amit, I did I note that touch of not sarcasm really, but I'm not getting that word for it. But something akin to that in your voice. Yeah, something like that might happen. Let's wait and watch. I must say, I mean, some of the recent innovative product launches by some of the mutual funds have been pretty interesting, I must say. Anyways, maybe that's for another show. For now, moving on to the third question, and that is, I've kind of added the age filter myself, because we didn't get the exact question about that if I'm above 50, whatever. But a lot of people were in that bracket, were still not completely retired, but doing that. And the question that came is that that these guys have seen equity markets do well. They're not risk averse completely. In fact, they are happy to be risk takers. But as prudence would suggest that as the age moves up, you probably need to, lower down the quantum of risk that you take in the portfolio. So Vishal, I'll start with you on this one. That consider an average person, she or he, above 50, enough risk tolerance. What is the lowest risk-free rate of return that the person can get, and would you stagger it out? I mean, what is maybe the maximum that somebody like this can hope for, and what are the products that would suit each return category?
So I think in general, fixed income returns for these investors will range between anywhere between 4.5% to about 7% overall, and therefore that's a fairly low number, considering the fact that inflation is itself ranging between 6 and 7% for quite a while now, and therefore there's been this natural tendency to want to move towards adding some elements of risk into individual portfolios. I think a good starting point for a lot of investors will really be to look at dynamic asset allocation products in their portfolio for two reasons. One is that a lot of these run with models that automatically adjust the debt and equity mix basis how different valuation parameters throw up. So, for example, they could have price to book basis, they could have a price to earnings basis, they could be using a whole bunch of other, either momentum or fundamental indicators to decide on what their debt equity mix is. And because they are very disciplined and remove the emotion out of investing, I think it works well for investors to look at participating in them. The second reason why I think this works well is because we find that the contrast cyclical behavior that a lot of individual investors need to be able to display tends to be very hard to do. So, for example, as of now, with equities running up, very strongly in the last few months, it is very natural to want to add more equity into portfolios. While what dynamic asset allocation funds might be doing is they might actually be reducing it at this particular point. So I think it's great that these products can do it by themselves, and that's why I think it's a good starting point. I would only caution investors about two things if they choose this category. One is be mindful of any sort of credit risk that is being taken on the debt component of these portfolios. And second is spend a little bit of time understanding the basis on which they rebalance between debt and equity, because a lot of products have different models in place. And therefore, just looking at past returns may not be the best way to do it.
And viewers, remember, it'll take time. If you don't have the time, then it's better to maybe pay a good advisor and that small fee in order to choose these products for you. Amit, your thoughts on the same question?
I think at the age of 50, typically a person or a woman, they have given away their housing loan and they are thinking of the property for their sons or daughters to inherit. Neeraj, we have to change this mindset. Instead of the property, we should actually ask people to inherit equity portfolios over 25, 30 years time. And this myth of at age 50, I should move from equity to debt, I don't think so. That's very much what you can say true today, because my aspirations, ambitions, and everything are actually going up even after 50. You have got many tour operators who actually take you to Switzerland and USA and places which actually cost a bomb. So if you want to beat inflation and if you want to be on the right side of double digits, I think there is no option but to go into equity. Only thing is, if you have a 5-year horizon and if you want a 70-30 kind of a debt equity mix, over a 5-year period, Neeraj, that 70 becomes 100. So your capital gets protected, while the 30 what you have in equity probably will give you that extra return what you always dreamt of. The whole, the client base what we have above 50, they only tell us one thing: we want a better post-tax than FD return, and therefore a simple product like an MIP or a 70-30 debt equity should suffice if they have no liabilities and they are sufficiently covered on the mediclaim part. So I think over time, 70-30 on a debt equity with balance advantage funds or MIP sort of structure, you can definitely beat a FD post-tax kind of return, and therefore you should be happy. Remember, not only inherit the property to your sons and daughters, but inherit your equity portfolios also, because over 20-25 years, they make much of a return to them.
I would actually, I'm sorry, I differ with Amit. I would say don't think of the inheritance, just spend all of it yourself because it's your hard-earned money. Your sons and daughters will fend for themselves. But anyways, I'm hoping my mom and dad are listening to this.
Yeah, and I am not your son. I am happy about it, Neeraj.
Okay, now let's move on to the next question. Actually, since Amit brought up that point, Amit, I'll start with you on this one, which is don't think of debt versus equity with age. I'm asking you, should people think of equity versus debt with the rising market levels? I think a lot of people have put in that question that should we move out of equity and park some money, or not entirely, but move out some money into equities, off equities, and park into debt because the market levels are so high. So I know the balance advantage funds would do it automatically if somebody doesn't have them in the portfolio. Are you telling your clients take some money off equities and put it into fixed income?
So it's one is the expectation management of the client. He is typically happy with a 12 to 15% kind of equity return. So clients definitely have an asset allocation model in place. Once you have an asset allocation model, what we do is we probably at the review have a particular date in mind every year for the client, and we definitely skim off the top on the equity if we find that the asset allocation ratio has changed more in favor of equities. So we go and stay in debt. If it's the reverse, we move from debt to equity. So look at your asset allocation number between debt and equity. And this time around, Neeraj, we have actually moved from equity to gold. So it's not always that it has to be equity and debt, but we feel probably there should be a 10% allocation to gold. So we book profits in equity and we have moved some of the clients to gold as well. So asset allocation is the key. Decide a particular date in a year and actually rebalance your portfolios. It does not matter whether it's 1st of January or 1st of April, but do it religiously, and I think asset allocation will pay you.
Vishal, have you done any such reallocation because of the market levels?
Oh, absolutely. I think we've been, rebalancing fairly aggressively. I think more aggressively than our clients would like us to, considering that fixed income returns are, fairly low at this point. So there is a natural tendency to want to go towards potentially higher return assets at this point. And I think there's a strong reason why we're doing this. I think we do believe that it's very important to protect capital during certain periods of time. And we could well have actually seen a lot of front ending of returns happen in 2020 in anticipation of a recovery post COVID and post a lot of other events that have happened globally. And therefore, we think it's a good time for investors to start to protect capital and therefore reduce their equity exposure. A lot of them are actually getting reductions in equity recommended, which is even beyond their strategically agreed asset allocation. And we could tactically be going underweight on equities at this point. What we are, of course, doing exactly like Amit mentioned is looking at gold as well in portfolios, because we think there's a very strong case to be built to have gold into portfolios, especially with the weakening dollar. And last but not the least, I think the need to be globally diversified remains as relevant today as ever, because a lot of the flows that are coming into India are probably tilting the recent returns towards India outperforming global equities. And therefore, there is a tendency to want to put more into India as compared to other parts of the world. And we think, if you have a single event risk, whether that risk will come from the budget, whether it will come from, some other event that takes place, I think, if you want to protect investor portfolios, it's very, very important to be globally diversified.
Niraj, can I have one observation here?
Yes.
Whenever you have the PPF rate actually lower than the housing loan rate, you always see a scramble for real estate. I think more our clients, we have advised them to prepay their housing loans, but more people are actually thinking of buying another house because that rate of loan is at probably 7.1, 7.2%, while your PPF is below that. So every time your PPF rate is actually below your housing loan rate, the housing loan is below your PPF rate, you see a rise in realty prices. And therefore, people are also moving from equity into real estate at our end as well.
Well, maybe that is what is reflecting some of this crazy number of subscription levels that we're seeing in real estate and registrations. Let's wait and watch. Okay, final question. Vishal, I'll start off with you. And that is, again, something that a lot of people would now, they start doing it late, but nevertheless, instead of doing it in March, it's better to do it in January. And that is tax saving funds. What are the best options?
So we think, there's a lot of options available. I think both Mirae Asset Tax Saver and Axis Long-Term Equity have consistently performed very well and demonstrated that they've, kind of been good choices for investors. I think we'd still like to suggest that even though it might be January, you can still stagger your investment in over 3 months rather than putting it in lump sum. And we're therefore suggesting that next year onwards, maybe do it over longer periods of time, assuming that tax laws don't change in the next budget. But if you do it this particular year, and you've clearly opted for the tax regime that was older, because I think one of the decisions that a lot of investors need to make is the choice of tax regime that they're going to implement for the financial year 2020-21, because the ELSS or ATC investments are only available if you are still in the old tax regime. So assuming you've opted for it, we think Mirae or Axis are both good choices, and just stagger your entry in over 3 months.
Okay, ideally plan it over 12 months. Amit, your choice of funds.
So I agree with Vishal here that we also have Mirae Axis along with Canara on the tax saving part. And what is more critical is that you need to look at if you are already full with your PPF and housing loan and LIC, then I don't think so you need to be in any tax saving funds. In fact, you can be in open-ended funds. People do a lot of SIPs into tax saving funds. And mind you, every installment what you pay into a tax saving fund has a 3-year lock-in. So whenever you are investing in a tax saving fund, remember these two things. If your ATC is already full, you don't need to do that. And second thing is, if you're doing a SIP, then your every installment actually gets in a lock-in for 3 years. Don't look at last year returns for tax saving fund to invest this year. Look at a quartile 2 performing fund over the last 5 years, and I think eventually they will become quartile 1. So as Vishal also said, we have Canara, Axis and Mirai, which our clients invest into when it comes to tax saving.
Gentlemen, I'm sure a lot of these answers help. Thank you so much, both of you, for taking the time out, and wish you and yours a very happy 2021.
Thank you. Happy 2021 to you and the viewers as well.
Thank you so much. And viewers, thanks for tuning into this leg of the Mutual Fund Show.